Good morning, everybody. Welcome to Thursday, the day after the night before. Hope you're doing right. Morning, Kay.
Good morning, Ryan. Good morning, everybody.
How are you feeling, mate? Another mentally grinding week?
Yeah, I mean, it's a bit strange week, but we had the big event yesterday. People thinking Powell being a little bit more cautious, which I thought as well. But then reading, and I know your opinion as well. Reading the comments, I think we are close to a 50-50 between people who think that it's just a temporary glitch in the dollar and other people who think that it's the start of the end. So it's going to be a funny one this afternoon, but we'll talk about the GDP later, I guess.
Yeah, we'll get into the Fed in a moment. We're just going to start by cracking over some of the data that we got starting from yesterday, just to give the usual rundown. MBA mortgage data still back on the slide there. Lower numbers coming in all round on that one. The bounce we saw a few weeks ago for a couple of weeks completely washed out now. We're back heading south. As we've been mentioning, we are seeing that appear in the main housing data. We did get the pending sales number down 8.6%, so that's 4 for 4 for the main housing numbers that we've had. That's starts, permits, new sales, existing sales, and now pending sales, all lower on the month. So as we've been saying, it's probably prices that's the final domino to fall there. But on the other side, we got durable goods orders, and this is one that we've been watching, to see if we're going to get some inventory problems coming in, based on what we heard from the Targets and Walmarts of the world, but no real signs there of any huge issues. Even stripping out the defence parts and the big ticket items like aircraft, which have been rising on the Ukraine situation, with obviously the US and other countries sending arms to the Ukraine. That there's a bit of that showing up in the durable numbers, as I say, for the big ticket items. But strip those out, and things are still holding up well, or well enough for the moment. So again, no real shocks to the economy there from that side of things. And durable goods can play into things like retail sales, because durable goods are things like washing machines and household appliances and that sort of thing. So the fact that orders are holding up there suggests also that perhaps the consumer, while it may be looking a bit weaker based on inflation, is not completely out of the game at the moment. Swinging around to this morning's data, let's get on there. And Australia had some retail sales out, slightly softer than expected, 0.2% versus 0.5% expected, down on the month, or lower than the month before. A little bit of noise coming out of Australia about the inflation that we got this week was a bit lower. Now retail sales are heading a bit softer. The same sort of questions that we're seeing around a lot of central banks and economies. Can the pace of hikes be maintained? Are the recession fears growing? So something we need to keep watching and see what the trends are coming out like there. Down some of the other data, Spain retail sales a miss on expectations again, but still a positive number. Again, don't know if these are adjusted for inflation either. So real retail sales may be in the negative, but just looking at the headline numbers, that's looking okay. Unemployment rate for the quarter down as well, so jobs are still being taken up in Spain. So again, we're not seeing every single data point collapsing. There are still some divergences here, but the market is still looking at the old recession fears coming up. Into the Eurozone, we've got the economic confidence numbers. Here we are seeing numbers all lower across the board there. There was a bit of a divergence. We saw the consumer inflation expectations rising again, only by a couple of pips, but firm selling price expectations were down a touch. Again, this is all feeding into the inflation story and those expectations that the central banks look at, whether the expectations are anchored. A bit of a dip there. It's a bit like seeing prices paid and those sort of metrics in the PMIs dropping back, which we've seen before. But as far as the consumer's concerned, the expectations are still for rates to run higher, or for inflation rates to run higher. Now, we also got a round of German regional CPI numbers, which were a bit mixed. We had Baden, Württemberg unchanged at 7.1, North Rhine jumped to 7.8, Bavaria jumped as well, then Hesse, Brandenburg, Saxony all dipped back. So a bit of a mixed picture there for the inflation numbers there. We do get the main number today at, I believe, at 1 o'clock. And let me just see what the number is for that. Where are we? So we're looking at 7.4 expected in the main German CPI number versus 7.6% prior. That may be round about the ballpark there. Let's call it up on this calendar so you can see that. So there, the CPI number, 7.6%. It might be looking at something a tiny bit lower, maybe 7.3, 7.2s, something like that. HICP looking at only a point drop. That's the main Eurozone number. Either way, you know, marginal changes if it's 7.3 or 7.4, still running well above the ECB's targets, at least in Germany, as is everywhere else. So unless we start seeing inflation really collapsing, the ECB are going to continue fighting that. And just on that, we did have ECB's Visco out, I think early this morning. He was playing down a big hike in September. That news I posted just a moment ago in the chat room. And then last night, we also had ECB Stornoras saying rates could fall in 2023 on recessions. So a couple of more dovish sounding ECB members there. You know, this is Stornoras talking about rates dropping in 2023, and we've only just had the first ECB hike. And that's the mess we're trading at the moment, the market matching what central banks are doing now with what they maybe have to do next year or in the next few months ahead. That's really creating a bit of a mess. And as Kay said, you know, for something like the Fed, it's causing two parties or two sides of the market to question, and, you know, are things bullish, are things bearish? And the same is going to feed across into the euro. Just looking at a couple of other bits of headlines, we did have North Korea's little fat boy, as Trump used to call him, Kim Jong-un, talking about he's ready to mobilize his nuclear warheads as a deterrent. So he's obviously been out the limelight for a while and wants to get himself back in the presses. We did get some comments from some Bank of Japan members and the government. We had Amara saying they need to continue with easing. No real change to rhetoric there. Amamiya, he was speaking that while they say that an exit is premature, it doesn't mean they're not thinking about how they might exit. So again, you know, this exit talk was something that came out a couple of months ago when someone first mentioned the word exit, and the yen got itself into a little bit of a tizzy there, or yen pairs got themselves into a bit of a jump there, just on the mention of exit. So, you know, another comment there. We've also had the government spokesman coming out talking about these rising COVID cases. Tokyo posted over 40,000 cases yesterday. So ongoing situation there with rising COVID cases, but they said they have no plans at the moment to restrict movement. So no signs of any big lockdowns coming in Japan. Back to the BOJ, Kay, I know you picked up on a Q&A that Reuters ran this morning with an ex-BOJ member.
Yeah.
Yeah, can you, mate?
Yeah. Oh, so you want me to? Okay. Sorry, mate. I was just busy looking at something else.
No worries, mate. I can.
There was.
Do you want to do it? Or
Come again?
Yeah, go on, go ahead.
All right. There was this kind of interview on a chat, Reuters chat with Kiyuchi, which is an ex-BOJ vice governor, I think. And there were some interesting points mentioned in there, saying that he thinks BOJ should change the monetary policy, but then he remained a bit vague on what he did. I think he was mentioning about the fact that they are moving towards their inflation, and but the wages are still a bit subdued. Not a bit; they are really subdued. So he was saying that the companies have difficulties to pass on the price hikes, which of course is dampening inflation. But he says really under current circumstances they should change their monetary policy, but it won't likely happen under Kuroda, and it will be a very slow process. So he doesn't think that they will change YCC an awful lot, but that they will more or less start to scale down on the ETF and the rates buying, and the process will be slow. He was also putting the blame again on those on the U.S. Yields for the yen weakening, and confirming what I've been saying many times, is that the Japanese community, the Japanese commercial and investor community, they are mainly watching at the US 10-year. He clearly mentioned this US 10-year again. So as I've been already saying a good few times, watch those US 10 years for yen. So he said it should be a long process, and he doesn't think it may happen under Kuroda. But then we have to note those two new members, although they haven't stirred any sake in the yen barrel so far, they are supposed to be a little bit more or less dovish, at least, than Kuroda-san. So we will have to see with Amamiya comments combined with that, if there is going to be a discussion about some moves in monetary policy during this fiscal year, or if Kuroda is really going to continue to stamp his authority on it and say not for as long as I'm the governor here. The other interesting thing I picked up on the yen was an article saying that they are actually shunning a little bit the US bonds right now, because the hedging costs, with the yen being so weak, the hedging costs are so expensive that they're actually investing less in US bonds right now. Which the article, I don't know exactly when it came out, but it may have hit also around the opening of Tokyo and scared a few people away. So we had this pretty severe move lower in the dollar yen overnight. It happened straight from the opening. It could be some end of month stuff. It could be linked to a mix of all those events. The FOMC we had, this shunning of US bonds, the comments here and there. So I'll look into the dollar yen, or we'll look into the dollar yen later and talk about the prices. But yeah, there's been a couple of article and events and comments and speakers overnight on the yen.
Yeah, we've also, I don't know why, but we've had a bit of a, well, I couldn't call it a flood, but of ex-central bankers. As Kay mentioned, one from the Bank of Japan there. We had Dudley out last night, just after the Fed, saying that people are underestimating how far the Fed will go. We've had ex-BOE man, Blanche Flower, this morning, saying it's a mistake for the Bank of England to go 50 pips. You know, it's the thing you have to take with these ex-central bankers, some more than others, you know, probably like ex-Bank of Japan bods, they're probably a bit more straight down the line. They're not trying to be clickbaity, but the others can be a bit clickbaity. It's all right to, you know, shout extreme opinions, if you like, when you're not in the role. It's always easier to shout from the sidelines. So these guys can be a bit clickbaity in what they say. It's always been a different kettle of fish when they're in the hot seat.
And if I recall well, Ryan, Dudley, was he not actually rather dovish when he was at the Fed himself?
No, he was a bit hawkish. He's one of these ones that swings.
Yeah. He was in the middle and then puts on a different cap as
yeah, exactly. Yeah. When it's bleeding obvious that they're going to be hawkish, that's when he jumps into the hawk boat. But it's as we saw, you know, that from the two new Bank of Japan bonds, you know, the market was saying, oh, you know, this could be a hawkish tilt. We're getting rid of one of the doves, and some of these guys coming in are going to be more hawkish. And then their first appearance, you thought, are these guys hawks really? You know, no real strong rhetoric that they might have spoken about when not in the hot seat. So it's just one of those features of people when they do get put in the real hot seat. You know, they tend to be a bit more conservative than other opinions. So anyway, let's just quick look at the data, because as Kay mentioned, we got the GDP coming up today, and this big feature of, is the US going to get into recession? Is it not? What does a recession mean? And, you know, we've had Yellen blathering about it, that a recession might not be what everyone thinks it is. You know, at the end of the day, if the market sees a negative number, it's going to scream recession, however they try and paint the picture. So we're expecting quarter-on-quarter growth at 0.5%. Later on today. That's going to be the number to watch. Obviously, spending numbers and things like that are going to be important, but the market is going to move on that headline GDP number. Really, with a lot of the market looking at the recession risk here, I think the price risk is if it's better than expected. So if it's positive, and B, if it's better than that 0.5 expected, that's going to get a lot of the bears, if you like, you know, changing their tone a bit, or shutting their gobs for a bit, and the market's going to say, yeah, you know, the Fed's on the right path here. They're going to continue hiking. So that's what we need to watch out for today. So let's jump into the Fed then. Obviously, there's lots to talk about regarding Powell and what he said and everything. So I'll give as I did this morning, you know, long story short version. I think the market has reacted correctly to what Powell said. And the reasons for that are things like you can see on the screen there. He's pulled back on the announcing what the rate hike is going to be in September. So there's going to be no more future guidance in terms of next meeting is going to be 75 pips or whatever. So in that terms, that's a change of tone. No more explicit guidance moving forward. He's also commenting on that his soft landing path is narrowing and could be, or has narrowed and could narrow further. That puts a bit more uncertainty into whether he can accomplish his goal of this soft landing. But as always with central bankers, you know, they play both sides of the fence. He has kept 75 pips on the table. And even while talking about it, he mentioned that if the FOMC wanted a bigger than 75 pip hike, he wouldn't hesitate to back a larger move. So although a lot of the market has taken all his comments yesterday as saying that we may not get as many hikes as possible, or as the market has been expected, from Powell's mouth himself, he has said they're going to fight inflation, and they're going to fight inflation until they've won the battle. That means that hikes are going to continue. What has happened is that he's lowered that path, so the hike path. So whereas the market was potentially looking at another 75 pips and keeping strong, he's now made that a bit more flexible. But from my point of view, I don't think that changes the picture. I don't think it shortens the path. I think it potentially lengthens the path. So if he'd kept with 75s, we might have got another one or two before slowing. Now we could find that we get 50s, maybe even 25s, but for a longer period. There were also a couple of key comments. I know Kay's got this one in his mind as well. He mentioned that we're pretty much round about the neutral rate, 2.5%, 2%, 2.5%. For me, that's pretty much confirmed what we saw in the previous dot plots, which is where the Fed members have pretty much settled their neutral rate. The question for me from here is, where's the terminal rate? And the terminal rate is how high rates will go before they come back to the neutral rate. Now, he was pretty explicit on the guidance for the neutral rate, but less so with regards to the terminal rate. Now, just my opinion on this, but I took his comments and the tone he was talking in to perhaps think that maybe they're going to be raising this terminal rate. Maybe they think rates could shoot higher than, I think the top end is 4% currently on the dot plot, that perhaps that terminal rate could be a bit higher than what they expect, but it might take a bit longer to get there. So overall, the market has reacted as I pretty much expected. You know, I've been saying in the previews and all week, you know, I see very little reason for the Fed to be extremely bullish. Any cause for them to be more bullish than they already are, more hawkish than they already are. So the path of least resistance is for anything less hawkish than where they're at now. And I think the market has reacted correctly to that. But as usual, I think the market has gone too far in that move. It's now turned far, as we call it, the boat running to the other side of the boat. It's gone far too extreme in its reaction to that. The Fed aren't going to stop rates anytime soon. He even acknowledged that at some point it will be appropriate to slow hikes. He hasn't said at some point it will be appropriate to stop hikes. So as far as I'm concerned, the Fed are going to keep hiking until they get inflation under control, even at the cost of the economy. And he mentioned that in his very first comments, where he, in the statement, you know, where they saw that he mentioned production and consumer has started slowing, but reiterated that the jobs market is very strong. And until we see that turning, I don't think the Fed are going to change. They're going to be data dependent. They're keeping everything on the table, but I think the path is just, and the velocity of rate hikes has just come down a bit, and we're seeing that in the reaction in the markets. So, Kay, what are your thoughts?
Yeah, well, exactly. What I said yesterday as well, I think he went from, let's say, uber hawkish to keeping the options open. But the change, and that's where the market, as you say, reacted correctly as well, to me, was that they recognized the slowdown a little earlier than I thought. So in that respect, it was a bit logic that the dollar got a bit of a slap in the face. I also think that there might have been positioning going on, but to me, yeah, as you also say, he leaves all options open, even to go faster than if the job market holds up, if PCE holds up, if GDP doesn't go into contraction, they might do another 75. But I think since he did mention neutral, that in my opinion, 75 is now going to be a higher hurdle than it would have been before. So that's a bit of the repricing. But then if we see the repricing, we have the FX moves, and then we have the yield move, right? So we have to differentiate both. The yields, so the short-term yields have corrected about what is it? About call it 10, 12 BPs on prior to the meeting, but then they are now stabilizing around those levels. So that is to say, like, take a 75 kind of off the table for now, but keep whatever is going to be expected as neutral and target still up around that 3%, 295. The 2 years is at 298 right now. The threes is around 292. So a bit of repricing, but not the longer term. So there is not more recession or risk priced in right here and now. If you look at the 10s, they've come off a little bit, but they are holding that famous 270. Okay, it did a small blip below there, but call it 270, 275, where really the support is. They did not go lower than that. So the yields market, in my opinion, is not ready yet to abandon ship on hikes. So there's not been a big retracement there. or a big collapse there in yields, which in my opinion is important, and which is going to be important for the dollar as well. So I have to, and I know that we will talk about stuff differently, but to me, these 2-3 days are really one package. You have the FOMC on one side, you've got the GDP, the second quarter GDP coming up, which may reverse or deepen the worries. We have, it's actually 4 things. Tomorrow we have the PCE up, if I'm not mistaken.
Yeah, on Friday, yeah.
We have of which Powell explicitly talked as well. And then in the mix, you have this whole end of month thing. So to me, we might not even see clear before tomorrow after the PCE really where the dollar is going to head to, and especially where yields are going to head to. I think today the GDP will be, as I say, it has the pretty binary event. It's going to be above or below freezing point. And from there on, you decide what to do with the dollar, and the rates guys are going to tell us what to do really with the dollars, because it's going to be interest rates and interest rates differentials in the end, deciding on what's happening, and then the real economic data are going to tell us what the thing is. What is funny for me is that both the White House, no, all 3 of them, the White House, the Treasury, and then Powell yesterday saying that they are not in a recession, and some calculations saying that even if it would go slightly negative now, 2 quarters is usually a technical recession, but they say it might not even be taken as a recession. So it's a bit strange, everything that's going on. Are they preparing us for a beat or a brushing under the table of a negative number? I'm not sure. But running forward on the events a little bit, I think if we get a positive GDP this afternoon, this whole dollar sell-off may reverse, completely reverse.
Yeah, I think they do make a half-valid point on a recession. I mean, you know,
it's a conception, right? It's a perception.
Yeah, a technical recession is one thing. It's 2, in most cases, it's 2 prints of negative quarter GDP. But, you know, that's why you need to look at the finer details. You know, yes, we're seeing housing slowing, but it's not collapsing. Prices are still holding up. Yes, we're seeing manufacturing and services slipping, services into contraction by 1 metric. But we're not seeing overall collapses going on. The jobs market is still very strong. Wages are still, you know, they're less than inflation, but they're still at good levels. So it's not like everything in the US or anywhere else has turned south and is, you know, falling off a cliff. And that's an important perception to make. So we may have a technical recession, and, you know, your zero hedges and your Bloombergs and every commentator out there is going to, you know, jump off their horse and scream that the world's coming to an end. But that's not necessarily the case. So personally, I wouldn't look at a recession and think, yeah, you know, we're heading into dark places right now. But that may not stop the market thinking that. And then you've got to think, is there a trade in there somewhere? But on the data front, yeah, we got PCE. But again, he's gone ahead and flagged another data point that we need to watch, and that's the employment cost index that we get on Friday. And it's a quarterly number, and it's not something everyone really pays a lot of attention to. Where are we? If it shows it on here. So here, this is Q2 numbers, so it's not even a monthly number. Wages and costs, you know, to see, they're going to be looking at that. Is this going to be hotter than expected? You know, and this is part of the employment situation. If they see that employers are still paying up for wages and to get staff in, this is an area they want to take some of the heat out of. And if that's rising, then they're going to keep the hikes in place and not think about turning the other way. But if that starts turning south, that's what we got to look at. And as you can see, there's the PCE numbers that we're expecting. Core PCE expected unchanged tomorrow. You know, that's going to be the main one to look at. So there's lots in the mix, but you know, as we say, I think the market has or particularly last night, went a bit too far in the recession fears and the Powell being not as hawkish. He had to acknowledge the bad data. There's no way you can watch the last couple of months or month and a half of data points turning south and not comment on them. It'd be a dereliction of duty if he did that. But at no point did he say they're worried about it or that they're prepared to stop hikes to counter that weakness. They're happy to see it continue as far as they're concerned, as long as it doesn't get out of control. May mean that the hike path isn't as high as mentioned, but they're going to keep plodding. And Mike makes a good point, and I'll ask this to you, Kate. A lot of people are saying, we're talking before the meeting, watch for a Fed pivot. Do you think this is a pivot from Powell? I don't, but what do you think?
No.
No.
It's not a pivot yet. No. No, we are
not. It's an acknowledgement that what's happened is exactly what they wanted to happen or expected to happen.
Still, I still got this one line in my mind, in my head, saying like there may be some pain to be taken in the process, and now they are acknowledging that there may be some pain on happening, and he even said it in his press conference, right? That they acknowledge that there is some pain to be taken. So no, I no, we know that this is not a pivot yet. No.
Yeah. So what do we do with it all in the aftermath? And this the picture in yields here pretty much says the case. We pretty much had a 10 basis point range over the FOMC, which, given what we've seen in yields moving at all stages of the Fed and everything else, pretty quiet. And the same could be said. Yeah, we got a fairly decent move in euro dollar. This spike up from the lows, but even as we sit here now, the steam's come out of it. Same as the ECB, we got a bit of a move, haven't broken any key levels, haven't broken any minor key levels. We couldn't even get up to these highs, 12, 102, 50s, 70s on that move. That gives you a sense of where we are in terms of what the market really thinks. Yeah, we get a bit of a volatile move, but it's nothing in the grand scheme of things. Now, I based on my view last night, I did jump into a short euro dollar at 102.03. I wasn't too keen on it. Even last night, I wasn't too keen on it this morning. I got out half the trade for 16 odd pips this morning when we dipped under 102, and then I moved my stop to break even on the rest. So gave the other half back when we spiked to 19, but here we are, collapsing under 102 again. We've been saying it for a while. There's no real reason why anyone would want to buy the euro, given the problems they've got going over there. But in the bigger picture, we're not moving anywhere. In hindsight, I probably should have just left the trade alone and waited to see if we got any moves to any better levels than I decided to jump in on. And the same could be said of where we go from here. We're going to mooch down to 101 again, or are we going to flap around 102? It's all a bit 50-50, as Kay mentioned, particularly on the dollar side of it. But if you look on the euro side of it, there's very few reasons why you want to be long, unless we get to some key levels, like we've been talking about down in the mid to low, 100s or whatever you want to call them. Dollar yen, that's probably one of the biggest movers that's continued. Now, I just wanted to highlight something quickly that I did in the room, purely a price action point of view. We're getting a similar picture that we got in April, May, setting up here at the moment, where we had a big leg up, then we hit some resistance, and the price just started moving down. We've got very similar price moves where we've had a little low, moved back to the highs, came down a chunk, moved up. The short-term trend is just edging lower again after we've had this phase up from here. And as I say, it's a similar picture. Now, I won't say these things go tick for tick, and what happened here in April, May is going to happen here again. But what it does do is it shows me, the sort of price action to look for where the line in the sand is going to be. We had it down here at 127. We were all looking at the 127 area. We had a break there, bit of an extension, but then we got back above it fairly quickly. That was sort of the break of 127. We got down to 126.35-ish or something like that, 30s. We've got a similar situation here, potentially down into the 135s, where we've got a bit of traffic, with the possibility of moving down to the 38.2 fib, 134.40-ish. And that is also a natural support and resistance area. It's a break point. It's found support and resistance at various times. So it is a big level here. If we get a break of this level here and it holds, that potentially means that we're going to see more than what we saw back in April, May. Maybe this is further signs of a top developing in dollar yen, and perhaps the mood changing in terms of how much further up we can go. So if we get that move here, just keep an eye on it. That could be a place where we do get a bounce and then off we go again. But that's, for me, looking at price action, they do tend to follow similar patterns, and we are seeing a similar pattern over here. So for me, the key area is going to be this 38.2 fib as to whether we're going to potentially break this trend or continue on higher. Kay, what do you think of this? Because it seems a bit detached from yields today. Yields dipped off as we were looking at in 10s, but they didn't collapse and they bounced a bit. But dollar yen kept going overnight. What do you think has been going on here?
Yeah, that's what I said earlier. I think there was this perhaps just a bit of positioning, and then technical breaks. There were some trend lines broken, but that leg in Asia may have been linked to Japanese seeing the technical break. The end of the month fixings could have been in there as well. It's all like circumstances coming all together for a washout,
Yeah.
Because I mean, let's face it, the longer term market will still be short yen, right? And they might indeed be looking at the underside of the box that you're just showing there. Anywhere between 134.40 and 135, perhaps, because the longer term market will have been long during the whole process of this move higher in the yen. And as you showed that prior box as well, like the 131, 126 that we had, this could be exactly the same move, and from there we move higher again. We have to wait and see what's going to happen on the GDP and the PCE tomorrow, in my opinion, and the last legs of the end of month flows to show us. But if it's only due to end of month flows, be careful for the saloon door come Monday, right?
Yeah, exactly. Because you've been noting that the euro's been pretty bid, pretty much into every hour. This is probably, and we're even seeing it bounce a bit here after it's been sold off. So it definitely looks like there's some end of month going on in there.
There's definitely end of month going on, but in the meantime, since there's so much weight hanging around the euro's neck, the euro crosses are undergoing the laws of gravity.
Yeah, and it's also worth mentioning that there are a lot of central banks that actually follow the Fed. A lot of countries who peg their currencies to the dollar and so on and so forth, and they've pretty much all hiked as well. Like Hong Kong, the HKMA, they hiked their rates after the Fed, straight after the Fed. A lot of the Middle East countries do so as well. So there is a knock-on effect from the Fed hiking, as I say, in that those countries, some of those countries who peg their currencies to USD or other things to USD, they all go and hike at the same time as well. And it's something that not a lot of people understand. I think there was a couple of Middle Eastern ones that didn't, or said they're not going to go as much if the Fed go high again. I think Kuwait might be one of them, coming out and saying, they won't. If the Fed go something like 75 pips again, they may not go as high on their hike in following suit. Do you want to take your screens for your little look around, Kay?
Yes, sir. Let me just move you
get those off.
To the side a little bit.
There we go. All yours.
Okay. Yes. Well, I had it on the dollar yen. So while you were talking about it, so to me, there's a couple of things happening here. Let me put it on a small, slower time frame. And I'm only going to talk short term. I think you covered the long term pretty well already. So this is the 134 40 40 50 40 60 extended even to 134 30. But in the short term, we've broken through the channel. It went quite fast once we and it looked really technical as well, because we went below, tried to break, retested it, and then we did the next leg lower. So here we are now. I'm really, I don't want to have a dollar yen position right now until I've seen the GDP, the PCE, and the end of month flows. I'd buy it actually here because of those yields holding up. But then if we get a bad GDP, I'm going to be crying. So I'm going to leave that one for now. But there's what I really want to look at today, is the euro and those euro crosses. So as we have already been saying, the models are showing that there should be end of month dollar selling. So I think some of them may have been waiting until after the FOMC to press a few buttons and sell dollars, and that could have been an accelerator for the moves that we saw post FOMC, regardless of what the decision would have been. And then we saw those equities move up, so that should in fact increase the need for dollar sales into end of month. But big but we have seen over the past months that a lot of those end of month flows tend to be done with a bit of anticipation, and especially if we look at the past months, we see the height or the biggest volume in the end of month being done the day before the last day of the month. So we have to be a bit careful here. But so far, into the top of the hours, we have seen a bit of euro demand despite what's happened over the past half hour, but I'll come back to that. And so we have to take care of, we have to watch and monitor those hourly fixings, especially into the 4 p.m. as well tonight. It might give us a good opportunity, because if you think that the euro has ran its course versus the dollar and we get an okay GDP, and despite that, euro put in euro dollar would spike on into the 4 p.m. London time, it could give an opportunity to sell a few. I'm going to watch, keep an eye on that. But for me, the euro dollar, it's still the same thing. It's at 70.80, 102 70.80. As long as it doesn't break, it's going to be tough to see it move a lot higher. Back below, I think we should look at the 101.30 again, and then just below 101, see what happens after the GDP today. I don't have a euro dollar position. I can't buy euros right now because of all the weight hanging around its neck. But this one, if we get a half decent GDP, I'm positioned actually via an option. I bought a 2-week put, a 10040 put, because that was the most cost effective 2 weeks to see if the euro loses its steam completely, to see if I can capture which would now be a surprise move, I think, a move back below parity in euro dollar. But it's just, I didn't want the cash. I didn't want to risk a big figure on the cash, so I paid about half a big figure for that, which is in the light of the month's moves is quite reasonable. But as I said, the ones I want to focus on the most today are the crosses. Before that, I want to just highlight this. This trend line here in the cable, it's struggling with it. This is from the February highs over April, and then here again, it's cable is struggling in the 121.80s. I think it's quite important to see a close today, or even after the PCE, even tomorrow, if one wants confirmation and not rushing to things. But keep an eye on this 128, 121, 80, 90. It has capped on the cable. If we get backs up, 121.30 is a starter, but backs up 120.90, there may be a few weak longs needing to get shaken out. But for the time being, I'm mainly watching this trend line. On the crosses then, so the main one I have right now is still the Euro Aussie. And as we were starting our show, I've been highlighting this 145.5 support on the Euro Aussie, and we're trying to break below it. We had this double attempt earlier in the week, one on the day before yesterday, then one yesterday, and it bounced, but we failed to bounce even to get back into this into this downward channel, which is still not good news. And again, I want to always, when I'm in positions, I always have my cheat sheet and my control sheet with me, saying that is this position still viable. But I think as long as the global economic data don't collapse, and with the weight hanging around the euro shoulder, and this is still a valid move that we are in. So I'm into Euro Aussie. I'm still a Euro Aussie short, and see what happens there. The other one, which I put on again a little bit in between, in the middle of nowhere, I'm going to say, but is the Euro Canada. I was in doubt yesterday whether I should have it or not, so I went in and out. But this morning I saw it again. Those retracement moves, we can't hold above 131 the figure right now. So this morning, as we went back below this line here, I decided to go small in, hoping for a move back to 131, even 131 and a half. I would love to get to try and get back into shorts again, with an eye on oil. Oil is rebounding from the supports in the 93 bucks. It's trading quite big again. So as long as that is happening, and with my bias in the euro, this is one I'm trying to play as well. I think that there's a chance we are getting back to those prior lows, and then if you look at the long term, it could actually be on its way to slightly lower levels again. Why not come back to stuff like 127 here? I've got an extension at 127. Why not? So that is another one that I'm in right now. I want to keep it. I want to have a look at this one, and unfortunately, we have to say what it is. I've completely missed that one. I was short at one stage here, and then with all the uncertainty and with all collapsing, and I brought it back like really far too early. But here we are, and we are trying to move back into a more trying to move back into this downward channel that we were trading in for a while from the 2020s, and we're right on it. This is 991. This is the last retracement level around 985.86. If we close the day below, it's looking as Euronoki can go back down again. It's trading 988 for the moment, so we are below this trend line. So this is one that I was monitoring, but unfortunately didn't capture on that one. I know that other people in the room did though, which is a good thing always. And then look at my metals. Gold, solid rebound. but then, and it is true that we have this extra little layer here. We have this extra little layer here around 1947-48, where we halted this morning right now. But I do think we need this break of the 50-60, and the shorter the time frames, the more we see resistance in that 50-60 zone. So 1750-60, and then 1770s. They're all going to be a little bit of resistance. So we really need to look at how the economic data are going to evolve, whether yields are stabilizing here with okay data. I think they might have a chance of moving a little bit higher. Otherwise, this could be a complete range play. One could argue that we have like an inverse head and shoulder, which would put the neckline around here as well, around 1748.50. So there's another layer of importance around this zone. On sorry, moving over on silver, this is starting to look a bit more promising. We've moved back out of the triangle, and right after the Fed, it spiked, and we are now back testing this resistance line here around 1740, call it 40-45. So this zone 35-45 is pretty important in my opinion for a close tonight. I'm still call long. I added just a little bit today. Just to see if we can keep it and go above, get a close above. I may start really to add more for a return up to higher levels, back into the 20s. Why not around 21? But I'd actually like this, despite what may happen to yields, I'd actually like a good GDP and a decent PCE for silver to outperform gold, because silver being an industrial metal. If the data hold up, it could really outperform gold and going further. In turn, if we start to get a negative GDP, this may spike because the yields will come off. But is it going to be viable? Is another question for me. So I'm watching the GDP for further clues. And for me, that rounds it about up right now, Ryan.
Yeah, no worries, mate. I'll grab those back. Where are we? There we go. There and there. Yeah, I want to look at Euro Sterling quickly. I know Gavin's mentioned that as well. It is looking very soft at the moment. I had a try here, as I mentioned this week. I was long at 84.20, 84.05. That's been blown out today, 83.75. I had my stop there. I really am thinking about folding in my core longs as well. My average is 83.50. So, you know, we're very close to that, getting that break even. As I've been saying, the carry costs have been weighing and been eating into the profits. It's been a trade that I've been in for quite some time. You know, I have knocked some out in the 86s and fortunately got some out when we moved above 87s in that last go. But, you know, it's not doing what I want to do it at the moment, and it's costing me money just to stay in the trade. And as I'm on my jollies next week, I'm just thinking about folding it up altogether, and then coming back and seeing what's what afterwards. It may be that we are going to get a move down towards the lows again. Let's just take that out a bit. You know, we could get a move down towards the 82s if that's the case, and we go down there, and I like what I'm seeing, and I'll just pick up some more longs again and try it again. Conversely, you know, I'll look for potential moves on the upside. You know, if we get a decent break of this, then that's an area I can buy in to a possible break and move up. But I'm not looking to hopeful about this one at the moment, so I may just throw in the towel on it. Take my money off the table. I will be giving a bit back, and if I don't close it above my average. But as I say, the costs of staying in longs in this one at the moment are just bleeding it away, and I don't want to do that. So that's one definitely to keep an eye on, because and this again, I don't think we're moving because of pound strength, because everything's rosy in the UK. We're moving because the euro is sucking more than elsewhere. You know, what's going on in Europe with everything, the war, gas, everything is just a big weight around the euro's neck in every pair. You know, as Kay's looked at it, the crosses, CAD, Aussie, you know, there's not really a pair that's got an EUR tag on it that's doing well, and this is no different. So how do we assess everything that's gone on? Put a bit of a summary before we close up for today. It's all about, you know, key levels. You know, we take a look at Aussie dollar, got above, you know, it's stuck its nose above the 70 handle. I know this is an area Blake's been looking at for a while, but it can't hold it. Same for euro dollar now. Had a poke above 102, can't hold it. You know, cable had a little poke above the 1280, as Kay said, can't hold it. You know, it's a theme that we're seeing time and time again. The only one that's really, or the only asset that's really holding up is stocks. You know, we're up above that 4,000 level. That's been a bit of a line in the sand recently. Again, another one that a lot of people are looking at. Can we get and hold above 4,000? It's done that. Let's go into a bit of a shorter time frame. You know, we're up there. We've had a couple of pokes above. Now it's holding as support at the moment. So, you know, you wouldn't think that stocks are reflecting the possibility of the US going into recession this afternoon. You know, and that's been the theme in stocks really for the last few weeks. It hasn't been getting the bug from recession. Whether it's still trading this, you know, QE stuff, they're thinking that a recession means the Fed are going to go backwards, and QE is going to start coming again, or they're going to reduce QT and, you know, keep the punch bowl just there a little bit longer. I think that's a misplaced theme, if you like, or thinking from the market. But, you know, the market's got far deeper pockets than I have if I want to fight it. But let's see what this does over the GDP. If we get a bad number, if it does move into recession and stocks move higher, you know, that's just further confirmation that they're trading this outlandish thought that the Fed might stop hiking and turn back to QE, and everyone can be supportive of stocks again. So for stocks, this is going to be an important number as well on how we react. Right, I don't know if you've got any other questions in going on before we call that a day. As I've said, if you're a bit confused by the noise of everything that's gone on with the Fed, what it actually means, what the market's thinking is, you know, you can strip yourself away from the noise. Just look at your charts, pull yourself out on the time frames, go to the wider time frames, and just ask the question: has anything changed? Has the market changed? Have we broken any ranges? Have we gone anywhere that we haven't been before? And if the answer to that is no, then, and I think the answer is no, then we just stick to trading the ranges. You know, you pick your levels, wait for them to happen, and trade against them and see what's what. And you can pull yourself away from the noise and what I think, what Kay thinks, what anyone thinks. And as we say, just trade the damn levels. Anyway, that's it for today. Keep an eye on that data later on. Please stay safe. I wish you all well for the day. Thanks, Kay. And we shall see you tomorrow for more fun and games.
Cheers, mate. Stay safe, everybody.